Just like many growth stocks, Twilio has been absolutely hammered over the last few months, with the stock down by more than 75% from its all-time highs. Twilio also happens to be one of Cathie Wood's higher conviction picks, which is currently the 10th largest position in the Ark Innovation Fund. The question is, should you follow Cathie Wood and buy Twilio? My name is Riado, and in this video, we'll do a deep dive on Twilio, look at its financials, and find out if it's a good investment at current prices. If you prefer to read the article version of this analysis, you can find the links to my articles in the description down below. With that out of the way, let's get started. Jumping right into Twilio's business, Twilio is the leading customer engagement platform powered by its core cloud communication services and customer data platform. It is a software as a service company that provides the software layer and data layer for companies to engage with their customers. As you can see, this chart right here provides an overview of Twilio's entire tech stack. At the bottom of the tech stack is the super network, which is the infrastructure that creates the platform to allow consumers and companies to communicate with one another over the internet or over the cloud. So with the communications infrastructure in place, companies can start communicating with their customers through various communication channels, including SMS, voice, email, video chat, WhatsApp, and Facebook Messenger. For example, Airbnb uses Twilio SMS to send automated messages to consumers regarding trip confirmations or reminders. Another great example is when customers use Uber Rides or Uber Eats, and when they place an order, they will get notifications in the Uber app, and that is basically powered by Twilio. One more example is the job search platform Glassdoor, which uses Twilio email to send highly personalized emails to job seekers and employers based on their interests. On top of their programmable communications cloud channels, they also offer security services such as verification and two-factor authentication via SMS, voice, email, push notifications, and one-time passwords. This is achieved through their apps, which are called Twilio Authy and Twilio Verify. Twilio also offers intelligence and orchestration services such as Autopilot, TaskRouter, and Studio. I won't get into these because these are not Twilio's core products. And finally, Twilio offers solutions which consist of higher level APIs that caters to more specialized areas such as Twilio Flex, which is a contact center platform solution, and as well as marketing campaigns through its email platform SendGrid. Twilio also offers Segment, which is the customer data platform that it acquired in November 2020 for $3.2 billion. In a nutshell, Twilio Segment is the leading customer data platform. It allows companies to collect first-party data that Segment is able to collect from the digital touchpoints that customers interact with across multiple channels, whether it be websites, apps, social media, and so on. So by combining Segment's customer data platform and Twilio's core programmable communications cloud services, companies are better able to engage with their customers and run hyper-personalized marketing campaigns. So Twilio generates revenue in two ways. First is subscriptions, and the other is through a usage-based model. So for example, if Uber or Airbnb sends more SMS to their customers, then Twilio will generate additional revenue, more revenue based on the higher volume of SMS sent to customers. So currently, Twilio generates the bulk of its revenue from usage-based fees, which is about 70% plus of total revenues, and the rest of the revenue comes from subscriptions. So turning to its market opportunity, Twilio management gave us an estimation of its total addressable market, which is about $110 billion market for Twilio. So Twilio did about $2.8 billion of revenue in 2021, so there's a lot of room for growth for the company. In its Q1 prepared remarks, Twilio CEO Jeff Lawson also gave us three macro trends that are creating tailwinds for Twilio. The first trend is continued digital transformation, and as you know, the pandemic has pulled forward years of growth into just a few months or even years. So as you know, because of the pandemic, people are increasingly using their devices and spending time online, which really creates an opportunity for companies to engage their audience, which are predominantly online at the moment. And that's where, based on Twilio's 2022 State of Customer Engagement Report, it reported that companies expect their investment in digital customer engagement to nearly double by 2025. It has also found that companies that invested the most in digital customer engagement have reaped substantial benefits and have seen revenue growth of 70% on average. So clearly the value proposition is there, and Twilio will benefit immensely from this digital transformation. The CEO continues, and he said that the second trend is consumer privacy. Third-party cookies, which are now blocked by Firefox and Safari, will also be blocked by Google Chrome by the end of 2023. So because of the changing data privacy landscape, this will be a tailwind for Twilio, as Twilio segment is helping customers drive efficiency, effectiveness of advertising campaigns that can no longer rely on third-party cookies. And over half of businesses we surveyed aren't ready, and over 80% are still reliant on third-party cookies. So since Twilio segment collects first-party data, a lot of companies are likely to migrate to Twilio segment's customer data platform because of this changing data privacy landscape. And last but not least, CEO Jeff Lawson mentioned the third trend driving customers to Twilio is the direct-to-consumer model. So DTC is not only disrupting how brands engage, interact with, and market to customers, but it's critical to driving loyalty and increasing profit margins traditionally paid in fees to intermediaries. So again, the DTC model is gaining popularity, and these companies are relying less and less on big tech such as Google, such as Apple and Facebook, and so on. This is going to be favorable for Twilio, especially for Twilio segment, which offers first-party data. Now let's take a look at Twilio's financials and growth numbers. Revenue grew 48% year over year to $875 million in Q1. This is due to increased usage and adoption of Twilio's products. It is also due to higher A2P fees imposed by certain carriers. And finally, the company acquired a few companies such as Segment, ZipWhip over the last few quarters, which contributed to the revenue growth that we see today. As you can see, revenue growth has been strong over the last few quarters, with revenue increasing quarter over quarter over the last 2-3 years. However, due to the law of large numbers and tough year-over-year comps, we're going to expect a slowdown in growth over the next few quarters. And this is already reflected in customer growth, which only grew by 14% to 268,000 customers in Q1. But despite the slowdown in growth, Twilio added 12,000 new customers quarter over quarter. I think this is because of the increasing attractiveness of first-party customer data platforms such as Twilio segment, and this is unfortunately offset by high churn due to the 2020 election year that I just mentioned earlier. Nonetheless, I think this is still a very strong customer growth, which is a leading indicator of revenue growth. And as customers start to spend more in Twilio's platform, then revenue should grow as well. The slowdown in revenue growth is also reflected in dollar-based net expansion rate, which was 127% in Q1. Even though 127% net expansion rate seems high, it is still below its average of around 130% plus. All in all, I think Twilio is still showing strong growth. However, we may see slowdown in growth in Q2 due to tough year-over-year comps. Nonetheless, Twilio is still a high-quality business with strong competitive position as the leading cloud communication platform and customer data platform, and I expect the trend to continue, and there's a long growth runway ahead for the company. Now turning to the profitability of the company, gross profit grew 42% to $425 million in Q1, which is a 49% gross margin. As you can see, gross profit margins, whether it be non-GAAP or GAAP, is trending downwards right here. And although we see an improvement in Q1 over Q4, it is still slightly below last year's numbers. And this is due to the growth of international messaging, which has lower gross margin profile than other Twilio products. Higher A2P fees and higher network service provider fees also contributed to lower gross margins. As you can see here, average GAAP gross margin for the messaging business is only 45% compared to other products which has very high gross margins right here. So usually messaging is the first product that new customers use when they join the Twilio platform. However, they may expand to other products such as voice, email, and app services, which should be margin accretive in the long term. And since Twilio is focused on acquiring customers, we can expect gross margins to trend slightly downwards, and over time it should improve as more customers adopt more Twilio products. Now gross margins looks pretty fine. However, if you look at operating profit, it paints a very different picture. As you can see here, GAAP operating margins are still very negative at negative 25% as of Q1. This is due to the company reinvesting into growth as well as heavy stock-based compensation, which if you adjust for non-GAAP expenses such as stock-based compensation, we arrive at a non-GAAP operating margin of about, just break even right now. So although the company is reinvesting into the platform, I would like to see material improvement in both non-GAAP and GAAP operating margins moving forward. And I think we're starting to see that here, where there's a spike from negative 34% to negative 25% operating margins. And although one quarter doesn't make a trend, the quarter-over-quarter improvement is definitely encouraging to see. And now if you look at the bottom line, we can see the same trend for net profit margins, which are still negative, just like operating profit margins. And the same goes for non-GAAP net margins, which are just hovering at break-even levels. So overall, Twilio is still a very unprofitable company, but I believe in the company and I believe that gross margins will improve as well as operating and net margins moving forward as the company pare back on spending and more customers adopt higher margin products. Now let's take a look at the financial health of the company. Twilio has $5.2 billion of cash and short-term investments with $1.3 billion of total debt. That makes its net cash position to be about $3.9 billion. Now do note that Twilio's cash position has been bolstered by equity and debt offerings, most recently in March 2021 when it raised $1 billion of senior notes offering, as well as February 2021, which is a $1.5 billion equity offering, which happens to be executed at the all-time highs back in February last year. So even though the timing of the offerings are really great, the company locked in ultra low interest rates as well as prices at all-time highs. However, do note that this cash is coming in from external funding instead of cash flow from operations. And that's where you can see that free cash flow margins are still negative as the company is reinvesting into growth. But good thing that the company has a very strong balance sheet at the moment and they can use that cash to reinvest into the business or even look for M&A opportunities. Now turning to the outlook of the company, management expects revenue to grow to $912 million to $922 million in Q2, which is a 36% to 38% year-over-year growth. Now, as you can recall, this is a slowdown from the Q1 revenue growth of 48% as well as the 50 to 60% plus growth that we've seen over the last few quarters. Organic revenue is expected to grow 27% to 29%. Again, this is a slowdown in growth from the 30% plus to 40%, 50% plus growth rates that we've seen over the last few quarters. And not surprisingly, the company still expects operating losses as it reinvests into the business. But despite the slowdown in growth and unprofitability, the CEO of the company wrote the following statement. He wrote, "For 2022, the setup in the second half of the year provides for a more favorable comparison." So what he's trying to say is that the slowdown in growth in the first half of the year is due to tough year-over-year comps, and we should see a re-acceleration of growth in the back half of the year. And he also mentioned that the company is confident in achieving non-GAAP operating profit in 2023 and 30% annual organic growth through 2024. The Twilio board also recently granted performance-based equity awards to its executive team that are directly tied to these metrics. So it's really good to see that the board and management is aligning their interests with that of shareholders' interests. And do know that the company has a perfect track record of beating analyst estimates, so whatever guidance that management has given is likely to be conservative, and whatever that analysts estimated is likely to be beaten as well. Before we move on, if you enjoyed this video thus far, I would appreciate it if you can click the like button and subscribe to my channel so you won't miss future content. Now turning to the moats of the company, I think the company has a scale moat. It is virtually a monopoly in the cloud communication platform as a service category with 38% market share. As you can see here, Twilio has a 38% market share, and it seems that it's growing exponentially quarter over quarter. There are other competitors such as Bandwidth and MessageBird, but it seems that Twilio is far ahead of the race. Twilio segment is also the number one customer data platform with 8.6% market share, with the next biggest player with only 1.2% market share. Next, I think the company also has a switching cost moat. Twilio offers a communication infrastructure which is very hard to replace and replicate. Twilio also runs a land and expand strategy where companies who join the platform will eventually spend more on Twilio's products. As you can see here, the longer a company stays in the platform, the more it spends, and therefore the more commitment it makes in Twilio's platform, and therefore the switching costs gets even higher. Next, I think the company also has a technology moat. It has the largest market share, and it is also recognized as a market leader in the cloud communication platform as a service category and customer data platform category. As you can see here, IDC recognized Twilio as the leading worldwide communication platform as a service in 2021. And here G2 recognizes Twilio as a leader as well, and segment as well right here. So being recognized as the market leader in both categories speaks volumes about the technology that Twilio and Segment offers. Next, I think the company has a network effects moats. It has 268,000 plus customers, which consists of 36% of global 2,000 companies. It also has 500 plus consulting partners to help distribute Twilio's products to prospective customers. And also, Twilio's customers are not just some random small customers, but they include big tech such as Amazon, Nike, Shopify, Mercado Libre, Nubank, Sony, Uber, Expedia, Airbnb, Atlassian, PayPal, Chase. So I think the ecosystem is very durable, very strong, and that should be a tailwind for Twilio in the long run. And last but not least, the company has a culture moat. The company has a Glassdoor rating of 4.3 out of 5. It is also named the number 14 best places to work by Glassdoor. CEO Jeff Lawson is also a top 5% CEO in Comparably, with a rating of 4.4 out of 5 for the company. In the end, people are what drives the company forward, and to see that the company has been recognized as the best places to work with the best CEO in the business, it shows how strong Twilio's culture is. Ultimately, competitors can copy products, but they cannot replicate culture. Now, turning to the valuation of the company, I think Twilio is trading at very attractive valuations today. The company trades at an EV to sales multiple of 3.4 times, which is lower than its historical lows as well as historical average. So I think there's a large margin of safety and attractive risk to reward for investors at the moment. Now, if we look at Wall Street analyst ratings, we can see that there are 31 analysts in the last 90 days that cover Twilio. There are 21 strong buys with 0 sells at the moment. And as you can see here, the average price target is $214 with the high of $320 and the low of $120. So the current price is $100, and if it returns to the $214 average price target, that will be an easy double from current prices. And the current price is also lower than the most bearish analysts at the moment, which is $120 target. I'm not saying that this is going to be the bottom, but I think there's a lot of fear and pessimism on growth stocks at the moment, and I think Twilio is attractive at current levels. I know that growth is slowing down and the company is still unprofitable, and I expect volatility moving forward, at least in the short term, but I think the valuation is very attractive, and the sell-off is just overdone in my opinion. As for risks, just like I mentioned earlier, even though valuation is very attractive, the company is still unprofitable, and in this market environment where interest rates are rising and inflation is raging right now, I think a lot of investors are flocking to companies that are generating cash instead of burning cash, just like Twilio. And that could spell trouble for Twilio, and it could lead to further sell off in the company's stock. The next risk is management changes. I think there's a lot of management changes in the last few quarters, which can be concerning for investors. As you can see here, in April, the company hired new Chief Digital Officer as well as Chief Privacy Officer, and in May, it also hired a new Chief Marketing Officer. And I think the most notable change was the appointment of Elena Donio, which will become Twilio's President of Revenue. And it turns out that she is replacing Mark Boroditsky, which is the former Chief Revenue Officer of the company. It is important to note that Mark has been with the company for 7 years plus, and therefore when he left the company, it did raise a few yellow flags. But I think Elena, the new President of Revenue, is a great replacement for Mark, given that she's been on Twilio's board of directors for over 6 years. So I think she has a lot of experience in the business, she knows the ins and outs of the business, and therefore I think she will make a positive impact on Twilio. The last risk that I see is dilution. Now if we go back to Seeking Alpha, we can see that on December 2016, basic weighted average shares outstanding was 53.1 million, which is at that time was its IPO year. And since its IPO, shares outstanding has grown to 177.6 million as of the latest quarter. So this is because the company is issuing more shares to fund growth. It is also spending share-based compensation to compensate its employees since it's not generating cash. And as you can see here, share-based compensation is still very high at about 20% of revenue. So therefore, I think investors should be aware of dilution, as it can put pressure on the stock price. So what is my overall thesis on Twilio? I think Twilio is a virtual monopoly in the cloud communications and customer data platform segments. It also has a long growth runway supported by its scale, network effects, technology, switching costs, and culture moats. It is also experiencing tailwinds from the digital transformation, changes in data privacy landscape, as well as a shift to the direct-to-consumer business model. Growth in the business is still strong, however, we may see a slowdown in growth due to tough year-over-year comps. Furthermore, the company is still unprofitable, which may not be favorable for investors in current market conditions. Well, despite the risks, I think the valuation is very attractive and there's a large margin of safety for investors. As for me, I have recently purchased shares of Twilio, and I will wait for the next quarter to see if I should add more or not. I think Twilio is an incredible business and I think it has a bright future ahead. But what about you? What are some of the companies that you're looking at or looking to buy? And also, if there's a company that you want me to cover in this channel, please feel free to let me know in the comment section down below. Well, that's it for me today, guys. If you liked the video, please leave a like, comment, and subscribe to my channel so you won't miss future videos. Thank you guys, and I see you guys on the next one.